Hey everyone, happy Friday. I'm Phil Hodgen and welcome to the Hodgen Law PC International Tax Lunch. We do this almost every month on the last Friday of the month, 9 a.m. Pacific time, noon lunchtime on the East Coast, late afternoon for those of you in Europe. Have a glass of wine, it enhances the performance. You can listen online as you are right now, or later we'll grab the video and we post it on YouTube in our channel, Hodgen Law PC 1700. This month's topic is this 962 election. So Section 962, I've got this long garbly thing, but it's, you are a human. You're telling the IRS, tax me like a corporation, daddy. And that's what we're going to do today. We're going to talk about what happens when you, as a human being, are a shareholder of a controlled foreign corporation and you make the 962 election and you get taxes if you're a corporation. So let's get going. Let's get going. There we go. All right, here's the outline, the table of contents, so you can read along later. And you'll see I have election effect 1 through 4. What happens is the 962 election has 4 impacts on your tax liability. We'll roll through them one at a time. After we do one, we'll do a little mathematical interlude, and you can see the economic impact that that particular facet of the 962 election has on your income tax liability. And we'll roll all the way through until eventually we have all 4 of them, and you can see the grand total. So let's start. What is the Section 962 election? It is an election that you, as a human taxpayer, U.S. person, human taxpayer, make. And all it does is it affects the income taxation of Subpart F income inclusions on your income tax return, or what is going to be called net CFC tested income, formerly known as global intangible low taxed income. I mean, slightly less of a mouthful, so this is good. And the new name change is effective as of 1/1/26. That's the One Big Beautiful Bill Act thing did that. And as I said, when looking at the table of contents, it has 4 impacts. 3 of them make your tax go down. 1 of them makes your tax go up. And so we'll look at the net effect and you can see how things move. It's really an individual situation by individual situation to see how it's going to net out for you in the long run, whether the 3 downs are better than the 1 up and vice versa. One of the things that came along with the slides today is a spreadsheet, and I give you a really simple model of what I show in these slides. So you've got a little Excel model, a dumbed down version of these calculations. So you can sort of throw in your own numbers and you can do a side-by-side comparison of what happens if I have a CFC with $600,000 of net profit, which is going to be the model that we're looking at all the way through today, and make a 962 election, or I don't. And what does the tax load approximately look like? So that's what, anyway, 962 election has these impacts in 4 areas. And specifically, here they are. So the first impact it has is on what is the amount of income inclusion on your tax return. And what's then we say this is translated into the existence of Section 250, basically. So all of the Subpart F income is going to be taxed at the same volume, the same gross amount inclusion, whether you make the election or not. But for Section 951 Cap A income, formerly known as global intangible low taxed income, soon to be known as net CFC tested income, there is a Section 250 deduction, and so only 60% of that income is taxed. So taxed on less income, a good thing. Second thing is the tax rate. Without the election, the gross income inclusion, whether it's Subpart F income or Section 951 Cap A income, is going to be taxed at the same rate as gross income. And whatever your tax rate is on the marginal scale, as high as 37%, it is. Whereas with the election, you're going to be taxed using the corporate tax rates, which is a flat 21%. So lower is better. Next thing is foreign tax credit. Your foreign corporation may well be operating in a country that has a corporate tax. And so your foreign corporation is going to pay corporate tax, income tax in the foreign country. Can you take a foreign tax credit for the tax paid by that foreign corporation on your individual income tax return? The answer is without the Section 962 election, no. With the Section 962 election, yes. And with a slight haircut. So more foreign tax credit is better. We like that. The final thing is, so those are the three good ones. The one bad one is when you are taking distributions from your foreign corporation, dividends to the extent they're out of E&P. When you do not make the Section 962 election, the magic of a code section called Section 959 operates, and it says, well, this is a distribution out of previously taxed earnings and profits. Therefore, it's not a dividend to you, just take the money and run. So that's great. So if you do not make the Section 962 election, you can basically pull the cash out tax-free from that foreign corporation. Not talking about the tax impact in the foreign country. The foreign country may treat that as a dividend to the shareholder and tax it accordingly. But on the US side, it's wonderful to not have the Section 962 election. On the other hand, if you make the Section 962 election, all of a sudden that distribution out of previously taxed earnings and profits is nevertheless a taxable dividend, and deal with it accordingly. Finally, just as it's a small note, but it's annoying, net investment income tax is going to apply to all distributions from your foreign corporation, whether you make the Section 962 election or not. If it's a distribution from E&P, whether previously taxed or not, it's included in the tax base, the income base for the net investment income tax, and you'll get taxed at 3.8%. So there's the quickie summary, and now we're going to get nerdy. Oh, footnotes here for your slide 5 so you can see what's going on. Procedurally, how does this work? You make it a year-by-year basis, so you can make the Section 962 election one year, not make it the next year as you choose, toggling it on and off. That's fine. If you make the election, it applies to all of the CFCs that you have. So you can't sort of rifle shot it and say, well, that one, it's useful to me to use the Section 962 election treatment. I'm going to use it not for that other CFCs. It's an all or none for all your foreign corporations. And finally, how do you do it? You bolt on a statement to your personal income tax return, and there's the citation to the regulations so you can see what the statement has to say. I've done a whole nother 1 hour on the election statement and how you put it together and what it should say and whatnot, but I'm going to skip over that for today. Finally, who can make the Section 962 election? Answer is a US shareholder, and this is what it looks like. It's going to be a human, a US human who owns the foreign corporation shares through a domestic pass-through entity. And if you look at the regs, you can see a cross-reference so you can figure out what a pass-through entity is. But as you might guess, it looks like suspiciously like a disregarded entity, a grantor trust, a partnership, like that. A domestic estate can make the 962 election, and a domestic trust, so a non-grantor trust, can make the 962 election because a grantor trust is a pass-through entity. If you don't want to do it, I'm just giving you a little list of alternatives to the Section 962 election in case, for reasons particular to your situation, the 962 election won't work. So the first thing is, well, if I'm 100% owner of a foreign corporation and it's creating this just brain damage with Form 5471 and Section 951 Cap A and all this rubbish, how about I make a check the box election and make it a disregarded entity? Well, if it's a pass-through entity, you don't worry about it for Section 962 doesn't apply, and subpart F income doesn't apply because all of that only applies to foreign corporations. I don't have a foreign corporation for US tax anymore. And you might say, well, yeah, why? Why would I want pass-through? Well, look at it this way. A CFC is a pass-through entity, whether you like it or not, just with some absurd accounting rules and some absurd tax compliance rules. So you've got a pass-through entity anyway. Why not get a pass-through entity like God intended, like a disregarded entity or a partnership? It might make your life easier on the US side. So anyway, think of this. Sometimes the foreign entity is not eligible for a check the box election, in which case you're stuck. Other ways, sometimes you do the math and it looks worse if you do the pass-through entity choice. So this is very much an idiosyncratic situation. You have to look at it piece by piece. Next, domestic corporation operating as a branch in a foreign country. So just like you file an 1120-F here for a foreign corporation doing business in the United States, what if you have your US corporation doing business in the other country, register there, do business, and file their equivalent of an 1120-F? Will that work? Will that be better? Well, maybe. Again, do the math. Excel is your friend, and you're going to do some little models and figure out whether it makes sense. Next idea, US parent foreign subsidiary. This is really what the global intangible low taxed income and all of this stuff that we operate with. Congress has this concept in mind that the tax rules that they wrote are for corporate businesses doing business over the border, so multinationals. And so there is a much cleaner flow of tax consequences from a foreign subsidiary into a domestic holding corporation in terms of dividend flow, in terms of how the subpart F and global intangible low tax income flows in and whatnot. So it's more built for it. Will that make a difference? Well, maybe it might be better. And you have to run the math, because when you pull the money out of your US holding company, it's a dividend, a qualified dividend, and you have to calculate that tax into the picture, but it might work. For a lot of situations, an American living abroad operating a normal business, you're not going to throw a US parent on top of a Canadian operating company just because maybe you made your life simpler in the US, but you've caused yourself an enormous amount of brain damage in Canada. So you're not going to choose that. Next one, don't be a US shareholder, right? These income inclusions all apply to if you are a US shareholder of a controlled foreign corporation, then you have income inclusions. Well, what if you're not a US shareholder? Hey, presto, no income inclusions. And that means getting yourself under the 10% threshold of stock ownership by voter value. Again, the other side of that equation, income inclusions happen when you are a US shareholder of a controlled foreign corporation. Well, what if the corporation is not a controlled foreign corporation? Controlled foreign corporation means more than 50% owned by US shareholders. What if US shareholders own exactly 50%? Hey, presto, not a controlled foreign corporation, income inclusions go away. Finally, the high tax exception. So if the foreign country tax rate on this corporation is at least 90% of the US rack rate for corporate income tax, currently 21%. So if the corporate tax rate in that foreign country is 18.9% or better, you can make the high tax exception election, and all of a sudden your controlled foreign corporation is going to be taxed like a C Corp. You, the US shareholder, are not going to be taxed on any of the corporation's income until it's distributed stream to you as a dividend. So that's pretty useful as well. So anyway, these are your alternatives to the 962 election, but let's just assume we're going to go forward with this 962 election, or at least we're curious about it to see whether it's plausible for us. So the election effect number one, this is not for subpart F income, but it's for section 951 cap A income. And I'm going to refer to it like that because of the name change that we're in the middle of in the good old days, i.e. today, global intangible low tax income. in the world of tomorrow, i.e. 2026, it's going to be net CFC tested income. So just referring to it all generically, it's the same income, Section 951 Cap A. So here we introduce the first thing where Section 250 deduction, which is normally reserved only for domestic corporations, is now extended so an individual taxpayer can take the 250 deduction. So if you look at Section 250A1, it says, here's a deduction for domestic corporations. Pretty clear. But by regulation, the 962 regs say this 250 deduction extends to individuals who make the 962 election. It does not apply to Subpart F income. It only applies to Section 951 Cap A income. And that last bullet point, whether you call it net CFC tested income or you call it global intangible low taxed income, up to you, depends where it is. Now, so you get a deduction because you've made the 962 election. How much is it? It's automatic, it's arbitrary, it's 40%. As of this moment in mid-2025, so for the 2025 tax year, it's a 50%, but starting 1/1/26, it's going to be a 40% haircut. So Congress reduced the Section 250 deduction slightly. And handy dandy little pictures, how does it work? If you have, looking forward to 2026 and using the 2026 numbers, if you have a controlled foreign corporation and it has Section 951 Cap A income, which is net CFC tested income in 2026, and you don't make the election, here's what happens. Gross income inclusion, all of the net CFC tested income, the Section 951 Cap A income. There's no deduction. Therefore, 100% of that income inclusion hits your Form 1040 and rolls through to become taxable income because there's no deduction to reduce it from gross to taxable. With the election, you have the inclusion of 100% of the Section 951 Cap A income, but you have a deduction. And the deduction shows up as 40% of whatever your inclusion was. So as a result, the taxable income that you report on your Form 1040 is only going to be 60% of the inclusion. And I'll show you how that happens on the very next slide. If you look at the tax compliance, the top row is for someone who does not make a Section 962 election, and the bottom row is for someone who does make a Section 962 election. And you can see how the numbers bounce from one form to the other. Starting on the left, you got your raw data, and it's ending up on the right on line 16 of Form 1040, which is, here's your tax liability, buddy. So you start at the top and you go from, you've got raw data and you're in Schedule I1, you bounce through from one form to another, and you see on the far right, line 16, taxable, that's the tax liability. But you see as it progresses one to the other, how the inclusion flows from 8892 all the way through to the 1040, and it's included in the Schedule 1 as income. And then it drops onto the 1040, and then it becomes calculated out your tax. Whereas on the bottom, making the 962 election, we kind of take the train off the rails and make it take a dirt road. And that's what's going on in the blue area. Again, you're going to start with the raw data, and you're on 5471 Schedule I1 because it's Section 951 Cap A income. You're going to go and play around on Form 8992 to figure out what your inclusion is for that income. But then what's going to happen is you're going to, in the blue boxes, all of this is going to happen on a roll your own, build it yourself in Microsoft Word or whatever you're going to do, statement that you're going to bolt onto the back end of your Form 1040. And this is the Section 962 statement. Because a Form 1120 has a line. What's your Section 250 deduction? So you can put it right in there and it'll adjust the taxable income of the C Corp. You don't have that line on a Form 1040. So how do you do it? And the answer is, well, they're not going to adapt the Form 1040 just for the little odds and ends like this. They make you do it in the Section 962 election statement. And so that's what happens. The income inclusion goes into the election statement. The Section 250 deduction goes into the election statement. You actually do the calculation of the tax on your election statement, and then you port that tax calculation out of the Section 962 election statement, and you plop it directly onto line 16. You know how they have those little boxes and you fill in a blank and you check the box and say, oh, here's some extra tax from over here and over there. Well, that's what you do. And then it ends up on line 16 as part of the grand total of your tax liability. So bottom line, you get Section 250 deduction, lower gross income, lower taxable income. No, same gross income, lower taxable income. This is good. So moral of the story, as I said, it's a situation by situation sort of calculation. If your CFC is loaded up with Subpart F income, this means nothing to you. But if your CFC has all Section 951 Cap A income, then it's very, very important, and it's probably going to save you some money. All right, election effect number 2, the tax rate. So this is bolted right into Section 962A1. It says, hey, presto, these inclusions are taxed at Section 11 of the Internal Revenue Code. It's a corporate tax rate versus instead of Section 1, which is the individual tax rates. And because individuals can be taxed as high as 37% and corporations are taxed at a flat 21, 21 is lower than 37. We like lower is better for tax calculations. Simple, simple, simple. And this is what everybody focuses on when they start to think about the 962 election. Oh, lower tax better. Well, yeah, there's that, but there's a lot of other stuff and moving parts happening too. So let's do our first mathematical interlude, and the combined effect of the Section 250 deduction and the lower income tax rates, Section 11, 21%, instead of Section 1, which is as much as 37%. So the math, we start with $600,000 of just gross income inclusion, Section 951 Cap A. That's what's hitting you out of your Form 8992. On the left column, without the Section 962 election, you can see the Section 250 deduction is not allowed. That means the net income inclusion from Section 951 Cap A income is $600,000. You take your standard deduction. So this is going to be the tax rate, the 2025 standard deduction as slightly modified by the One Big Beautiful Bill Act. And we have taxable income of $584,250. And that results in an income tax liability of $174,035. As compared on the right, we have again the same gross income inclusion, 600,000, but now we get the 40% haircut from Section 250, so 240,000, which means the net inclusion of Section 951 Cap A income is only 360,000. Yay. Someone who makes the Section 962 election is not allowed to use the standard deduction. So we now have, or to offset to reduce this income, I should say. So therefore, we have taxable income of $360,000, 21%, $75,600. So what's the tax savings? $98,435 just because you made the Section 962 election. We like that. Less money paid to Uncle Sam is better. I have some footnotes there that you can use for the previous slide. And here is footnote 4 is just the tax table so you can see how $584,250 ended up with the tax cost that I calculated and the average tax rate that I calculated on that table. All right, let's move on to election effect number 3. So foreign tax credit. If we have to pay tax to Uncle Sam and we have to pay tax to another country, we would like, in a perfect world, to use a foreign tax credit one direction or the other, so the same dollar of income is not taxed twice, because that can tend to get expensive. So the problem here is how the foreign tax credit rule in Section 901 is written. It says that you, the taxpayer, can claim a foreign tax credit for income tax that you, the taxpayer, paid. Well, if you have a controlled foreign corporation and you're the shareholder and the controlled foreign corporation paid the income tax, you are not the taxpayer, so you are not eligible to use that tax payment as the base for a foreign tax credit under Section 901. So it's who paid the tax is the problem here for why we got this problem. And here's the default situation under Section 901, that we have a Canadian corporation pay tax to Canada, and we have a US shareholder who has to include the Section 951 Cap A income on his or her personal income tax return, and is now going to pay income tax on that inclusion to the IRS. And no foreign tax credit is allowed because the US shareholder did not pay the tax. The Canadian corporation paid the tax. The 962 election allows us to invoke the glories of Section 960. Section 960 is the indirect tax credit rule, or the deemed paid tax credit rule, whatever you want to say, which is yet another one of these let's pretend provisions in the Internal Revenue Code. And it says that if you are allowed to use Section 960, then we will pretend that the controlled foreign corporation that paid the tax will pretend that you really paid it. So in this case, if we can successfully invoke Section 960 to be used by the US shareholder, the US shareholder, a human being, gets to pretend that he or she paid the Canadian corporate income tax that the Canadian corporation actually paid. So we like that. We're willing to go along with this imaginative fiction that's all the way through the Internal Revenue Code, and we'll pretend that we actually paid the tax when we really didn't. So here is the Section 901 and the whole thing. And you can see in the part that's not bold, it talks about the tax that you actually paid, but it also has that bolded stuff. It says, plus, in the case of a corporation, the tax is deemed to have been paid under Section 960. So see how it's limited, that only a corporation can use that deemed paid under Section 960 additional foreign tax credit. Well, hey, presto, Section 962 says pretend that you, the individual, are a corporation. Now that we've pretended you're a corporation, we can pretend, to slot you into Section 901 as a corporation, and you can get the Section 960 deemed paid foreign tax credit. So there it is, hardwired into the Internal Revenue Code is Section 962A2. Now, when you're calculating a foreign tax credit, whether it's a directly paid or indirectly paid through Section 960, there are some limitations on how much you can claim against your foreign tax credit claim against your U.S. tax liability. In the case of using Section 960, the indirect foreign tax credit rule, there are going to be two limitations that apply to how much the individual taxpayer who made the 962 election can use as a foreign tax credit allowed on Form 1040 to offset U.S. personal income tax liability. The first haircut is 90% of the tax actually paid by the CFC. Now, this is different. This is new. In the bad old days, AKA today, before the effective date of the One Big Beautiful Bill Act, the haircut is 80%. So if a foreign corporation paid $100 of foreign corporate income tax, the individual shareholder who made the 962 election at most would be allowed for the 2025 tax year $80 towards foreign tax credit on the individual income tax return. That's changing as of 1/1/26. They increased it to 90%. So yay, there's more income tax possibility for the foreign tax credit for the individual. So just remember, we're toggling from 80% under Section 960D, like David, as the maximum amount that can be passed through to be claimed as a foreign tax credit by the shareholder. 1/1/26 forward is 90%. But that's the first hurdle. The second hurdle is the normal Section 904 limitation that says, well, even after we took 10% off the top for what you're allowed, the maximum you can take on your Form 1040 as a foreign tax credit will be whatever the tax, US tax was without, that's it. So if you're going to pay $100 on US income tax and you paid $120 of foreign tax, the max you can take in the United States will be that 100. So you offset the tax liability in the US, but you don't get 120 of foreign tax credit, because otherwise that extra 20 that you paid to Canada, for instance, would be reducing the tax on your other US taxable income, and Uncle Sam would be losing out on tax collections. So remember, step one, apply the Section 960D limitation. Step two, the Section 904 limitation. This is only for Section 951 Cap A income, aka global intangible low taxed income, net CFC taxable tested income. Subpart F does not have this 90% haircut thing. The only limitation is the Section 904 limitation. Weirdly, you're going to bolt on the corporate foreign tax credit document, Form 1118, not 1116, to your personal income tax return in order to show the foreign tax credit allowable. So, side effect number 3, continued, is that if you're going to claim the foreign tax credit, Section 960D, we're going to gross up your income again. And this is because if they didn't do the gross up, you would both be allowed a deduction with reduced income inclusion and a foreign tax credit. And Uncle Sam doesn't want to give you a deduction and a credit on the same income. So here is Section 78, and it says, if you, a domestic corporation, and remember you can substitute in your mind that a human who makes a 962 election is a domestic corporation. If a domestic corporation chooses to have the benefits of Section 960, then you have to include a dividend as received by such corporation. And I'll show you how that works in a second. So let's do it in the mathematical interlude. We have the gross income inclusion. Remember, we have the pass-through inclusion of $600,000. And well, let's just look at the corporation before it even touches the US, because we're calculating the inclusion that the shareholder will have. You're looking at the foreign corporation's financial statements or foreign corporation income tax return, however you want to look at it. You start without the Section 962 election. It's got taxable income of $600,000. It pays corporate income tax in the other country of $120,000, 20%. Okay, how much is the inclusion? Well, The inclusion is going to be $480,000 because that's the current E&P, and that's what's going to drop down to the shareholders' gross income inclusion, all else equal. So without the election, that's what you're going to have, 480,000. So that shows you the effect of the deduction for corporate income tax. And you can see that in operation on Form 8992. I can't remember what the line number is, but you compute gross tested income, and then you have expenses and taxes allocable to gross tested income, and you come out with net tested income. That's where that is. With the Section 962 election, the column on the right, again, we start with 600,000 of taxable income for the foreign corporation. We deduct the 120,000, so we've got what would ordinarily be the net tested income or current A&P, whatever you want to look at, of $480,000, but we have to add back the deemed dividend to result in a gross income inclusion of $600,000. So in the end, if you're making the Section 962 election, you're going to have higher gross income inclusion to start because you're going to use the foreign tax credit later to zero out the tax liability. And I'll show you how it zeroes out in the next slides. So now we have the gross income inclusion different, $480,000 without this 962 election, 600,000 with. Now the effect of the Section 250 deduction. Allowed with the election for under 962, not allowed without. We have the standard deduction on the left without the 962 election, no standard deduction on the right, because remember, this income is not even touching personal gross income. It's off on a side quest, and you're calculating the tax liability on the Section 962 election statement. So you have a difference in shareholder taxable income as a result of the way this is calculated. And you have income tax liability that's different by a lot, right? And specifically, let's look at the Section 962 election. Income tax liability at 21% is $75,600. Now let's move on to the foreign tax credit allowable. Since you did not make the Section 962 election, you get no foreign tax credit, so ignore that column. But let's look at what happens on the right and the effect of the two limitations on foreign tax credit allowable. The first, so top line is foreign tax paid in the foreign country. Second row is the 90% allowable. So take 10% off the top, and we have the maximum possible foreign tax credit the individual could take is 108,000. Then the third row down is the effect of the Section 904 limitation, which says in no event is the foreign tax credit allowable greater than the income tax paid on that item of income. So we pulled that from the previous slide, and that was $75,600. So the fourth row down is the actual result of the Section 904 limitation, and the maximum allowable foreign tax credit, $75,600. And finally, bringing it all together, what's your net tax liability after allowable foreign tax credit? On the left, without the Section 962 election, you don't get no credit. So you're, wow, look at me. Typo. Only after it goes 4 reviews and you still find a typo. So 36, typo. Yay. But let's look at the right, because that's where all the fun happens. Remember, we had calculated a tentative tax liability of $75,600 for the income taxation of the flow-through Section 951 Cap A income to this shareholder, the individual, with the Section 962 election. And we have, hey presto, a $75,600 offset by way of allowable foreign tax credit, which means the Section 951 Cap A income inclusion has a big fat net zero income tax liability impact for this US shareholder. And this is where the fun really happens. And in my opinion, it's all in the game of how much foreign tax credit can you use to offset the evil effects of subpart F, income inclusion, as well as section 951 cap A income. So moral of this story, when I'm looking at a situation and trying to decide what's the optimal structure strategy for an American operating a business in a corporation abroad, or any kind of controlled foreign corporation situation, I'm looking first at the foreign tax credit because I think that's going to make the critical difference. So, my opinion. So, your worldwide tax, and you just sort of see the cumulative effect, paying, and again, we've got typo problems. Paid $120,000 of foreign corporate income tax, both situations, with and without the 962 election. But with the 962 election, we pay no additional income tax. So that means your worldwide tax load is just whatever the foreign tax country paid. You got a load of paperwork on the US side. The tax compliance is a pain in the neck, but you've zeroed out the tax liability, and that's a very good thing indeed. Now, we move on to the final item. So we've got three things that should work in your favor. Lower tax rate down to 21%, less included income with a Section 250 deduction, and foreign tax credit allowable, which can zero out your US tax liability, whatever's left over after the Section 250 deduction, and even with the lower income tax rate. So now let's look at the one that pushes the results the other direction. It has the possibility of increasing the US shareholders' personal income tax liability. And that is that making the Section 962 election eliminates using Section 959 for distributions of previously taxed earnings and profits. So the election, in a summary, makes dividends mostly taxable. And the summary, so you know where we're going, without the Section 962 election, you are using Section 959 to treat all distributions of previously taxed earnings and profits. They're coming out of earnings and profits. Ordinarily, they would be a dividend because that's the definition of a dividend, distribution out of a dividend. But as previously taxed earnings and profits, because those earnings and profits were included in the US shareholders' taxable income previously. And 959 says if you have that magic, previously taxed earnings and profits and distributions from them, no inclusion in gross income. So therefore, if there's no inclusion, it can't be a dividend to the US shareholder. Great. With the Section 962 election, that rule is overridden by Section 962 little d, like David. And here's what Section 950, my God, my apologies. This should say 962. No, it shouldn't. This is 959A1. So this proves you how the dividend under previously taxed earnings and profits is not taxed. Here's 962. I did it right. Thank God. I was just finding typos everywhere, even in my imagination. So here's Section 962, and it says, look at that bolded language, notwithstanding the provisions of Section 959A1. So it says, ignore 959A1 and include the distributions of earnings and profits in your gross income. And then there's a little parenthetical that's not bolded after the bold stuff. To the extent that such earnings and profits so distributed exceed the amount of tax paid under this chapter on the amounts to which such election paid applied. What that says is you have a distribution. First of all, you have a Section 962 election in place. And then for the tax year in which you have a Section 962 election, you have a distribution from earnings and profits. The earnings and profits have been included in your gross income because they have. And it's a distribution of previously taxed earnings and profits. First thing you do is you look at the bolded language and say, oh, I'm not going to exclude it. It's going to be fully taxable. And then you apply the little words after the bolded section and says, to the extent, and it says, subtract the amount of income tax you paid on that inclusion of the earnings and profits. So if you had $100 of included Section 951 Cap A income, and then that was distributed, and you paid $21 on that 951 Cap A income, you would only have taxable dividend of 79. And I'll show you how that works. So you take the Section 962 earnings and profits. This is from the regs, so you can go read it and see if you can understand the regs, which are excruciating, as they all are. You take the distribution, you subtract the excludable Section 962 earnings and profits, and that is redefined as the federal income tax actually paid on these inclusions. And look at that, slide 43. I already saw that typo before. That Section 951, the second time I say 951A in parentheses, it should say 951 Cap A. Hey, there we go. Equals your taxable Section 962 earnings and profits. And that's how you get to a distribution that is out of taxable earnings and profits, and therefore it's a dividend, shows up on Schedule B, and you pay income tax accordingly. And it can be a qualified dividend or non-qualified dividend, whatever, does the foreign corporation qualify or not for qualified dividend treatment. So anyways, they're the regs. And all the way back to 1962, when Subpart F was bestowed upon us by our beneficent overlords in Washington, D.C., they give a little example of this. So we have $100,000 of CFC income, and it was included. Back then, there was only Subpart F income. There wasn't this newfangled 951 Cap A stuff. And out of that, and that was included in the gross income of the shareholder, and out of that, $100 was paid out as a dividend. And you can see back then they had a 52% tax rate. And so only $48 out of that $100 distribution would have been taxable dividend. The second thing on the distributions, net investment income tax. Net investment income tax is going to apply to all distributions from the CFC, whether you make a Section 962 election or not, whether it's from previously taxed earnings and profits or not. So end of story, whatever the distribution is, expect to pay 3.8% tax on it. And this comes down to the definition of net investment income tax. And if you go and you look at the table of contents for the Internal Revenue Code, you see something that's really, really interesting. You look at all of the income tax rules, and they are in Chapter 1 of the Internal Revenue Code. The net investment income tax is all by itself in a separate chapter. And so the net result of that is when you say, well, Section 959 says a distribution out of previously taxed earnings and profits is not included in gross income, that only applies to the tax rules in Chapter 1. It does not apply to the tax rules in Chapter 1A. I think that's what it is for the net investment income tax rule. So the bottom line is the calculation of gross income and taxable income, or what is net investment income, is a different beast entirely than how you calculate taxable income for income tax purposes. And it is explicit in the code and the regulations that we don't care about what other kinds of exclusions exist over on the income tax side. For net investment income tax, we are going to include dividends out of previously taxed income as net investment income because it's a dividend, because it comes out of earnings and profits, and we don't care about 959 and we don't care about anything else. So now let's wrap it all up with the effect of everything. And this time we're going to add on the layer of what happens when the corporation, the CFC, distributes all of its net cash available to the shareholder as a dividend, and we'll see the total tax load. And when I do math like this and I do what if projections, I like to take it all the way from the very beginning until the very end. It's not sufficient to understand the total tax load on a US shareholder, on any shareholder, until you have either liquidated the corporation and distributed the net assets upstream, and the US shareholder has the money in his or her pocket or its pocket if it's a corporation and is paid income tax. What you're looking for is all the way done until all the taxes are paid and there's a $20 bill in your pocket and you can go walk next door and buy a burger and a beer. So that's why it's important when you're doing these tax calculations to imagine either a distribution by way of a dividend or a liquidation of the corporation in order to understand the whole picture. Because if you give a client anything less than that, well, today it looks really good, and say, well, yeah, but you put yourself in a pickle 5 years from now when you're going to shut this corporation down, and that's when the chickens are going to come home to roost. So do it all the way through to the end. And let's look at it. Okay, we're going to go back to our simple model. We've got 600,000 of net profit, corporate income tax paid in the foreign country of 120,000, means $480,000 of cash is remaining eligible to be paid out as a dividend, and we're going to pay it out. I'm going to pretend that we have a US shareholder living in a foreign country, and the foreign personal income tax rate on that dividend income received, remember that US shareholder is a resident there, so taxable there as a resident, is going to be 40%. I'm going to pretend that it's a qualified dividend from the US point of view, so 20% tax rate. Ignore the net investment income tax later. I'll get to that. So 20% for the tax rate on the dividend. And let's look at the total tax load as offset by foreign tax credits. So on the left is the no Section 962 election. And let's total up all the tax payments. $120,000 paid to the foreign country as corporate income tax. The inclusion of the $480,000 of Section 951 Cap A income. Remember that calculated on Form 8992, the tax rate is going to be $132,035. Foreign tax credit against that, not allowed. Now, that's that part. Let's look at what the shareholder paid in personal income tax in the foreign country. $480,000 of dividend income, 40%, $192,000. Net investment income tax to Uncle Sam, 3.8% of 480,000 is 18,240. Worldwide tax load, $462,275,000. That's nearly a week's wages where I come from. Now, but let's look at the effect of the Section 962 election and the allowable Section 960 deemed foreign tax credit paid. You can take the tax credit as an individual for the corporate income tax paid by the corporation. So we start again with $120,000 of foreign corporate income tax paid. Can't avoid that. But now look at the first little grayed out box. We have our $75,600 of income tax liability on Form 1040 for the US shareholder, because it's taxed at 21%, and we had the Section 250 exclusion, deduction, sorry. But we got the $75,600 allowable foreign tax credit because of Section 960. We've zeroed out the effect of the US income tax system on this taxpayer on the corporate side. Now let's drop down to the individual side. 192,000 of personal income tax paid to the foreign country. Unavoidable, you're a resident, you live there, you pay income tax. But now let's look at the US side. It was a qualified dividend. The tax was $96,000, but the directly paid in Section 901, just the way it normally works, foreign tax credit allowable is 96,000. It's less than the amount actually paid, 192, but the 904 limitation says the max you can pay as a tax credit is whatever you would otherwise pay in the US, and that's it. We have net investment income tax, unfortunately, 18,240. But look what happened. Just eyeball it. The only tax, except for that dreadful net investment income tax, is the foreign tax. So functionally, you are just paying tax in the foreign country and not paying tax in the United States. You've got a buttload of paperwork to do with your income tax return in the United States, but zero tax liability, not counting net investment income tax. And, we have these cases sort of rolling through, and can we use a foreign tax credit to offset the net investment income tax? And the answer is starting to be, well, maybe in some situations, given whatever the income tax treaty says between the United States. So in certain situations, you might even be able to offset the net investment income tax as well using the foreign tax credit, in which case you have zero additional personal income tax liability and plus net investment income tax liability to the US government. So that's the big picture of how things work. It's one of these, the Lord giveth, the Lord taketh away. And as usual, there's a little bit of fiddly exception to the rule in the form of net investment income tax. And that's what the Section 962 election does. And looking at this, my hunch and operating assumption is that somebody who is operating a CFC in a relatively high personal and corporate income tax situation would be well served looking seriously at the 962 election, because the foreign tax credit is going to offset the effect of Section 951A, Subpart F income, and 951 Cap A, net CFC tested income. And the foreign tax credit is going to offset, on the personal side, the income taxation of dividend income. So your choices, I think, for someone who's living in a high tax country like that will either be the high tax exception or the 962 election. Anyway, let's wrap it up. Conclusion. As I said, I think the most important thing is how the foreign tax credit plays when you're doing your math. And the foreign tax credit will also work for you because usually high tax countries, they tax everything at high tax rates. They don't sort of distinguish between corporations and individual tax rates. Everybody's high, which means the foreign tax credit will work again on the dividend. But do the math. I've given you a little spreadsheet as the beginning of a what if model for you for with and without foreign tax credit. Pardon me, with and without the Section 962. So there you go. If you have questions about that, there's my contact information and email address. Shoot me an email. And finally, here's the standard disclaimer. Don't blame me if you put your foot in something. Do your own research. Don't rely on this. I'm just some random talking head on the internet. So don't believe me. Sign up for the newsletter. If you're not on and you're watching this, go to my website, hodgen.com, and sign up for the newsletter and get an email every other Friday. And I have a tax community for international tax pros. Maybe you want to go look at that. Anyway, thanks so much. And we'll see you next month. Next month, August 29, 2025, the topic will be Form 5471, previously taxed earnings and profits, Schedule J and Schedule P. So this is something that I've always just sort of tippy-toed around, like the pool is cold and I put my foot in the water and yeah, no, it's time to jump in and get all the way wet. So we're going to go deep on previously taxed earnings and profits and how it all works in the context of the CFC. So see you next month.